The Fed makes a hawkish pivot, the markets take a wild ride, and wage inflation takes a bite out of corporate earnings. This is Bloomberg Wall Street Week. I'm Romaine Bostick in for David Weston. This week, Stephanie Flanders on the Fed's efforts to fight the worst inflation we've seen in decades.
Now the market is coming around to the idea we might have 5 rate rises in the US this year. There's this feeling that, OK, that means they won't have to do so much later on.
Plus, investors adjust to the new reality of financial conditions tightening more quickly than anticipated.
You know, the market can overprice the pace of tightening here in 2022.
And climate capitalism. Barbara Ann Bernard on investing in a low-carbon future.
I believe in ESG 2.0, which to me is at the intersection of materiality and authenticity.
Fed Chair Jerome Powell made it clear Wednesday that the central bank is ready to raise interest rates in March to tackle the highest inflation in a generation. But it was the speculation about how far the Fed would go with its tightening cycle that sent waves through financial markets.
In light of the remarkable progress we've seen in the labor market and inflation that is well above our 2% longer run goal, the economy no longer needs sustained high levels of monetary policy support.
Equities ping-ponged between gains and losses, and trading volumes this week surging to the highest in at least a year.
We've been telling clients, say, the last 24 hours is, hey, turn your brain off for the next couple of weeks here. We've done enough on the downside, whether you're bullish or whether you're bearish. We've done enough here in the near term to catalyze a bounce.
A mixed bag of corporate earnings results from Microsoft, IBM, Apple, GE, and Tesla didn't help matters. And even for those investors willing to look past the Fed and look past disappointing earnings, the specter of geopolitics was right there to give them pause. Russia on the doorstep of Ukraine.
I don't think you can take anything from Russia at face value.
And it was a severe week here for equity turbulence. The S&P 500 saw 3 of the biggest intraday reversals of the day, the biggest. The S&P, which was down almost 2% from Monday through Thursday, ended the week higher by 0.8%. The NASDAQ composite, which had been down 3%, ticked up by less than 0.1% to finish out the week. The individual stock moves, they were just as dramatic. Microsoft swung 15% in 15 hours at one point this week and posted its biggest weekly point swing from peak to trough on record. Tesla finished today higher, but still lost about 10% on the week. And Apple, which had fallen for 8 straight days, rallied 7% on Friday, its best day since July 2020. Still, beneath it all was the thinnest liquidity since the pandemic started, making every swing worse and sending traders to the options market for protection like never before. The benchmark S&P 500, it's still on track for its worst month since March 2020, while the NASDAQ 100 is headed for its biggest monthly decline since October 2008. Here to bring some levity and clarity to what happened this week and hopefully to give us some insight into what may happen in the weeks beyond. Kristina Hooper, Chief Global Market Strategist with Invesco, and Jurrien, Director of Global Macro over at Fidelity, joining us right now to kick off our roundtable. And Kristina, I'll start with you, and I want to just get your initial gut reaction here to some of the moves that we saw this week.
Well, my gut reaction is that we probably should have expected this. What we're doing is going through a digestion period, a terrible digestion period that's likely to result in ulcers, but a digestion period nonetheless. And that's because, and really it started with the unofficial start of tightening season when we got the December FOMC minutes a couple of weeks ago. That told us the Fed had made a hawkish pivot. And then everyone scrambled to figure out what that exactly meant. And imaginations ran wild. Could be 8 rate hikes this year. And then we heard from Jay Powell this week. And while he certainly tried to soothe markets in some ways, he was very clear that the Fed is comfortable doing more this time around because the economy and labor market is in better shape. And so that has continued to cause fear and creating a re-rating among stocks, especially higher valuation ones.
Well, Jurrien, let's talk a little bit about what people are re-rating here. I mean, we've seen some pretty wild expectations for what the Fed might do, from 2 hikes to as many as 6 this year here. What are people positioning themselves for right now?
Well, there's a couple of elements to this. First of all, the rotation out of the high-flying sort of meme stocks, non-profitable tech, et cetera, that already began a year ago. So we're actually already a year into a rotation on the expectation that we're going from a year last year of a trifecta of tailwinds, right? 48% earnings growth, abundant liquidity from the Fed and from the fiscal side, very low nominal rates, negative real rates. We're losing two of those three pillars, if you will, and it's all up to earnings growth. And if you're a stock and you don't have solid fundamentals, you're not going to this is not going to be the year for you. And then the other element is that interest rates were pretty significantly repressed last year, and they still are to some degree through quantitative easing. And that has a direct transmission mechanism into the valuation side of the equity markets, right? If you plug that into a DCF, it added about 5 PE points to the S&P.
Well, I am curious, Jurrien, about earnings estimates, because we haven't, at least from some of the sell-side analysts that we track here at Bloomberg, they haven't necessarily come down, at least in aggregate, quite yet here. And I'm wondering if we still need to see, I guess, a little bit more capitulation with regards to folks' expectations about aggregate earning growth on the S&P 500.
Well, the estimate, the consensus estimate, which I get from Bloomberg every Friday, is for 2022 is now about 7.9%, I believe. That's about 100 basis points less than it was 4 weeks ago. So the numbers are coming down. But even if it goes to 7 or 6 or 5, obviously that's a far cry from the 48% we got last year. So earnings growth clearly is decelerating at the same time that the Fed obviously is accelerating its normalization process. And whether we get 4 or 5 or 6 hikes in 2022, I don't think is really the most important thing. I'm more concerned about where the cycle ends than how and when it begins. And it's interesting that despite all the hawkish jawboning from the Fed over the past month or two, that neither the Fed funds rate nor the Eurodollar curve is pricing in a terminal point of the cycle above 2%. So the expectations of how the cycle begins have been ratcheted up, but the expectations of how it ends have not really changed, even though the Fed is moving the goalposts here.
Kristina, how do you measure the communication so far from the Fed, to Jurrien's point, about how long this tightening cycle might be?
Well, I think what the Fed is trying to do is talk very hawkish, scare markets. That helps in doing some of the heavy lifting. And then it can certainly hopefully be a bit more dovish when it actually happens. I also think there's an element of this, conventional wisdom suggests that if they do it sooner, then there's less to do in total. And that's why we haven't seen much of a change in the terminal rate, because our expectations have changed about when the Fed's going to start and how many rate hikes we're going to see this year.
All right, we're going to continue this conversation right now with Kristina Hooper, Invesco Chief Global Market Strategist, and Jurrien Timmer, Fidelity Investments Director of Global Macro. We'll be back in a moment. This is Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm Romaine Bostick. We're back right now with Kristina Hooper and Jurrien Timmer. And Jurrien, I want to get back to our conversation here about the whiplash that we saw this week. A lot of folks in this market aren't necessarily in full agreement about where we go with regards to earnings, with regards to the Fed, where we go with regards to the economy. But underlying all that are basically the expectations people are trying to price in for inflation and how persistent that inflation could be.
Well, clearly there are signs that inflation is going to be more structural, but we have to remember that that has to offset very major headwinds or tailwinds, I guess, disinflationary tailwinds from demographics, from technology, et cetera. But our estimate is that inflation will calm down here just from the base effects, and also the economy seems to be starting to slow down now. that maybe the current 7% CPI print will settle down at around 3.5 in the coming year or two. And to Kristina's point earlier, that will actually give the Fed some cushion to maybe a year from now, after 100 or plus basis points of tightening, to say, okay, we don't need to shock and awe the markets as much because things will be moderating at that point. But clearly, between the labor markets and the housing markets, which are two major inputs into core inflation, it's possible that instead of the 1.5–2% that we've seen over the past 10–15 years, we'll see something closer to 3–3.5%.
And Kristina, to that point here, when we talk about what the Fed's trying to do with inflation, obviously it's trying to tamp it down, but it's also more about just bringing some stability here. It doesn't mean we're going back down to the days of sort of, sub 2% anytime soon, does it?
No, I don't think so. And I think the Fed recognizes that monetary policy can't solve for many of the sources of inflation that we're seeing right now. So I think there's that recognition. And also, it's a delicate balancing act. While the Fed believes it's achieved its full employment mandate and can focus on inflation, it still has in the back of its head not just financial stability, but also the importance of treading lightly so that it doesn't choke off this economic cycle.
So it doesn't choke off the economic cycle. Can they thread that needle? Are you confident in that?
I'm hopeful. I'm very hopeful that they can thread that needle. Certainly, it is going to be difficult, but the best approach is a data-dependent approach, and that's what the Fed has committed to. That means, though, that any inflation prints, as well as measures of consumer inflation expectations, inflation expectations in general, is going to have likely an outsized impact on markets, at least in the early stages of this tightening cycle.
But Jurrien, when we go and we talk about some of the earnings that we've gotten so far this earnings season, on every conference call and almost every statement, there's been some reference to inflation or supply chain issues, whether these companies have been able to pass some of their higher costs on to their consumer base. Do you think that the companies out there in aggregate have enough pricing power, have enough wiggle room to be able to share that cost with their end consumer?
Well, certainly so far, many of them have. But of course, that comes off a period over the past 2 years where consumers were really flush with cash, right? From stimulus checks, the CARES Act, et cetera. And so 2022 will be an important test that as that tailwind kind of turns into more of a fiscal drag, whether companies can actually still push through those costs or whether they need to absorb it. And I think when we're looking at earnings and as they evolve in the coming months for 2022, that really is the main thing that I'm watching to see if it starts eating into the profit margin, because the operating margins have really gone through the roof over the past 2 years, and that explains a lot of the very, very strong earnings gains that we've seen.
I'm curious, Jurrien, this week one of my colleagues pointed out to me some of the relative calm that we saw in credit markets against the backdrop of all the volatility that we saw in the Treasury market and, of course, in equities here. What is that telling us?
Well, certainly high-yield credit spreads, although they've ticked up this week, remain extremely well behaved, and that does suggest that this is more of a liquidity event than a fundamental event, at least so far. Of course, in the credit markets, many issuers have termed out their debt, so they don't have that wall that they had, for instance, in 2008. Not to draw a parallel between now and 2008, but in 2008 the bond market shut down. They couldn't refinance, and that was a major systemic issue. That's not the case right now. Defaults are very low. Everyone has turned out their debt at low interest rates. So there really is not a credit problem right now. I'm more interested to see what will happen to the TIPS market as the Fed withdraws, quantitative easing and starts to run off its balance sheet in the coming few months or year, because the Fed owns almost 30% of the TIPS market. And if it's one thing that has been a puzzle to me is why hasn't the 5-year TIPS break even reflected the increase in the CPI? I mean, the 5-year forward TIPS is still at around 2.2%, so very, very stable. But it's a question as to whether the Fed owns enough of that market to control that spread.
It's certainly interesting to see. Kristina, I am curious also about your thoughts on the credit market, and more so in the context of how healthy some of the balance sheets of these companies are right now.
Well, it certainly varies by industry, but I have to say that balance sheets in general look better than they did in 2008. I think we're in a healthier environment this time around. And from my perspective, we have a better chance of a soft landing with the Fed, even if it gets more aggressive than we anticipated. Of course, the one big question mark is starting balance sheet reduction so early in the tightening process, and of course, the potential for it to be quite significant. So we want to watch that carefully. I know that last time around when we saw balance sheet reduction, it didn't have a negative impact on stocks, but we want to watch that carefully because I think that's where we would see an epicenter in terms of reaction.
There's also a lot of cash sitting on the balance sheets of some of these companies. I mean, we talk a lot about Microsoft and Apple and the cash hoard that they have. What do you think they should do with that cash? More stock buybacks, dividends, Kristina?
Well, I think that for the most part, dividends make a lot of sense. That keeps investors interested, and it provides a source of stability when there's significant volatility. So I'd love to see more of that money go towards dividends. And of course, it's also tax advantage for investors. So it's a nice little gift.
Jurrien, your thoughts on that?
I think share buybacks have been an underappreciated force in this bull market, at least the one that started in '09. So in my view, this is a secular bull market. And when you add up mergers and acquisitions and buybacks, both of which are companies buying other companies' shares and therefore those shares get retired, and you compare that to IPOs and secondaries, the ratio of demand for shares from corporates versus supply of shares by corporates is about 8-to-1. So that is a very powerful supply-demand dynamic. And last year was a record in buybacks. I think companies, or at least many of them, would prefer to buy back shares than to issue dividends because there's something more sacred and less cyclical about dividends. But I think that will continue. And companies, as you point out, are flush with cash. And there's only so many things you can do with them. And there's been there's been a very consistent pattern where companies, even after satisfying capital expenditures, when you add up dividends and buybacks, it's about 10% of sales for the S&P, and that's been a pretty stable number for the past 10, 12 years or so, and I suspect that will continue.
All right, I'd be remiss in letting both of you go without talking about some of the geopolitical issues. I mean, obviously the Fed moved markets, earnings moved markets, but there was certainly a whipsaw effect that we saw earlier in the week from concerns about what's going on between Russia, Ukraine, and how the U.S. could potentially be in the middle of that. Jurrien, how much do you price in geopolitical issues like this into the market, if at all?
The question I always ask myself when something like that comes into the headlines is this systemic for the global economy, for the U.S. economy, and therefore for the markets? And normally, if something happens with Russia, which is not a huge player on the economic scene globally, I would say this is not systemic. But of course, this time we have a massive energy shortage, certainly in Europe. And of course, Russia is a major player on the energy scene. And so that would be the transmission, how the Russia-Ukraine issue could become systemic because it could feed right into an energy shortage in Europe, which is already facing a massive increase in costs for natural gas and other forms of energy. So I'm worried about it because that, if oil was at 30, we would, for me, this would be a non-event, at least for the markets, but that's not the case right now.
Kristina, does it give you any worry? Do you prepare for this at all?
Well, I do because it has the potential to exacerbate the inflationary pressures we're already experiencing. So not dissimilar to the emergence of Omicron variant, which can contribute to supply chain disruptions and increased costs, this could also do the same. And so I just worry that it could, if it were to result in a significant crisis and a big increase in oil prices, could result in perhaps pushing back a little the peak when we anticipate inflation peaking this year. But beyond that, I don't think it's going to have a dramatic impact over the long term. Geopolitical risks rarely do.
Geopolitical risks certainly rarely do. And just final question to you, Kristina. We're going to look ahead to more economic data. Next week, of course, we get the jobs report here. Are any of these data points enough to change anyone's opinion about the pace of the economy so far this year?
Well, the one data point that could is contained within the jobs report. And that, of course, is average hourly earnings, wage growth. And because that tends to be the stickier portion of inflation, that's going to be an area that the Fed is going to be keen to paying attention to because, of course, it could inflame inflation further. So that, if we see that to be significantly higher, we just got ECI, and where we're seeing the really significant growth, though, is on the side of services and healthcare. Those areas tend to be higher turnover, so they're the less sticky portion of the job market, but still, it could very well be a concern if we see heightened wage growth.
All right, we're going to have to leave it there. Kristina, it's always wonderful to catch up with you. Kristina Hooper there. She's the Invesco Chief Global Market Strategist in Jurrien. Always appreciate your contributions to this program. Jurrien Timmer, Fidelity Investments Director of Global Macro. All right, coming up next, we're going to take a look at what's coming up on Global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm Romaine Bostick. It's time now to take a look at next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, Romaine. It'll be a quieter week in Asia as many markets close to mark the Lunar New Year. But investors will be looking for further signs of policy support, with Beijing keen to show stability ahead of the start of the Winter Olympics in Beijing. Elsewhere in Australia, the RBA meets hot on the heels of last week's strong inflation print. Economists widely expecting the nation's central bank to scrap its bond buying program and potentially amend its forward guidance, opening the door to earlier rate hikes. India's budget also handed down, while we get earnings from big-name companies in the region, including Nintendo, Sony, Nomura and Tata Motors. Now over to Laura Wright in London. Laura?
Thanks, Juliet. Rate hikes from the Bank of England and the ECB next week. There's a cost of living crisis here in the United Kingdom, which is expected to peak in April. So all eyes are on Threadneedle Street following their surprise hike in December. Will they hike again next week? Meanwhile, the ECB's Christine Lagarde, it's anticipated she will shut down calls to normalise in 2022, but won't completely rule out raising rates by 2023. We're also monitoring the situation along the Ukrainian border, whether there's been any progress placating hostilities. Back to New York with you, Taylor.
Of course, the huge news here in the U.S. this week is all going to be about tech earnings. We have to start Tuesday with Alphabet, all about the top line growth and if it can be above the high teens this year. We move from Alphabet on Tuesday, Wednesday. Meta Platforms, we know this company as Facebook, of course, really looking to see some engagement slow within the main core platform. So this earnings report is really going to highlight how important WhatsApp and Instagram is, and of course, any other further details we can get on the metaverse. And then, of course, we push forward even further to Thursday, where we're going to get earnings from Amazon as well. You may start to see some slowing in that online retail sector, but again, look for more pushes in cloud services and, of course, that advertising business. The big report on Friday is all about Jobs Day. Consensus, of course, for 178,000 jobs. Really important as we're really trying to see how this Federal Reserve begins liftoff, perhaps in March. Romaine, back to you.
Thanks to Juliet Sally, Laura Wright, and Taylor Riggs. Coming up on Wall Street Week, we're going to take a look at the explosive growth of ESG investing. It's now a $35 trillion market. That's next on Wall Street Week. Welcome back to Bloomberg Wall Street Week. ESG investing, it's grown from a niche theory to a market that's tens of trillions of dollars strong, with investors of all stripes jumping on the bandwagon amid pressure from clients, shareholders, and regulators, urging them to take climate change and social justice into account. I sat down with Barbara Ann Bernard, the founder, CEO, and Chief Investment Officer of Windcrest Capital. All right, thank you so much for doing this, Barbara. And I mean, there's been so much talk over the last few years about the push into ESG, particularly on the E side of that equation. I guess the big question that a lot of people really want to know is sort of what are the components for investing in that space?
So I think everyone has a different version of ESG. I believe in ESG 2.0, which to me is at the intersection of materiality and authenticity. I focus particularly on the energy transition because I think it's the most impactful. I also really focus on holding my companies accountable. I call it carbon accountability. So we are active in our approach, and I engage with management teams, and I say to them, break out your CapEx. Let me see what you are spending on decarbonization and where. And then I want to see your carbon footprint, and did it go down? i.e., how good are you at allocating capital when it comes to reducing your carbon footprint? Because any CEO can tell you they're going to be carbon neutral by 2050. The reality is they're not going to be there. So are you on the right trajectory, and are you on pace to hit your goals?
Do you think that the metrics are there right now to accurately and fairly assess how these companies are making progress toward that goal?
No, which is why I came up with my own proprietary method called carbon accountability. Absolutely not. But that is also an opportunity. And, you know, in terms of the energy transition, I think the value investors' way to play this is through the green metals. I get Tesla-like growth at a commodity-like multiple. And if I go to places like Canada, I don't have to take on the geopolitical risk of other regions. But when you go to a country like Canada, what you are faced with uniquely or less uniquely, increasingly, is a carbon tax. So in Canada, companies pay $40 per ton today, and that goes up by $15 every year until it hits 170. So the first net carbon zero copper and nickel mine, Foran and Canada Nickel, which are both in our fund, will never pay that carbon tax. And to me, that makes that company so much more valuable because the discounted cash flows are higher. And so this is what I mean about companies that are using their CapEx to innovate and decarbonize as having a real edge. And, you know, so this is where I treat carbon as an asset. And not a liability.
Well, explain that a little bit more here, because I think for a lot of folks who aren't as knowledgeable about this as you are, they hear carbon as an asset and they sort of scratch their head. What does that mean?
Yeah, so effectively, carbon is very valuable because 61% of the world's countries and 20% of the largest listed companies in the world, representing 14 trillion in sales, have made commitments to decarbonize. There are some industries that can't get there. Right? This is unobtainable without carbon credits. So you have an asymmetric demand supply for carbon credits. So carbon credits are increasingly going up in price. And to me, this is climate capitalism. This is where carbon becomes a currency and an asset, not a liability for the best players.
There are a lot of people that look at, let's just take your turn of phrase, climate capitalism. There are investors who will say, all I care about is just maximizing my profits. Doesn't really matter how these companies make money as long as they're doing it legal. That's all they want. What's the shift in investor sentiment right now amongst the universe of people that you interact with regards to their attention to climate change and their attention, more importantly, to how companies can profit and prosper in a world where we are moving, I guess, towards lower carbon emissions?
Really interesting question, because there are countries that mandate you reduce your carbon footprint, but there are also companies that are doing it voluntarily, such as the cruise ships, because increasingly it's your social license to operate. People care. And if your customer cares, it's ultimately going to impact your share price. So this is definitely a shift, Romaine, and it's for the better.
It's for the better. You mentioned some of the countries out there. I mean, there's a pretty wide disparity in carbon pricing on country to country, of course, in terms of regulation, country to country. We've seen some of the Nordic nations kind of out in front on this. The EU has played a little bit of catch up, but they're now starting to push to the forefront. But then you look at some of the, I guess, more traditional developed nations in the Western Hemisphere, and they seem to be kind of behind the curve.
Yeah, so different countries have different pricing. So, for example, in the EU, it's over $100 a ton right now. In California, the price goes up by 5% plus inflation every year. So different governments can mandate different pricing schemes, but there's also the voluntary market. And that is where you list a carbon credit and companies buy them on a voluntary basis. So a Royal Caribbean cruise ship, right? They're not regulated under any government system, but they offset their carbon footprint. So that establishes there's a lot of demand for carbon credits. The other thing, Romaine, that I think is misunderstood is the supply. Why is there this demand supply imbalance? How do you create a carbon credit? And there are basically two ways. You can either do reforestation, where, for example, you take a mangrove and you restore it because a hurricane hit it. And just to put some numbers on this, because I think that's always helpful, in the Bahamas, where I'm from, we have 7,011 hectares of restorable mangroves. If we were to restore them, that would be worth $308 million in terms of carbon credits. That's reforestation. The other way is afforestation, where you take the carbon sequestration properties of, let's stick with mangroves and seagrass example, and you get it accredited by someone like Gold Standard, and you registered it with the UN FCC, and then you can sell those. And in the Bahamas, for example, if you were to do that, we have 97,000 acres of mangroves and 5.4 million hectares of seagrass. That would be worth $375 million a year. Every year.
That's impressive. If a company goes down that road, though, how do you verify it? How do investors know that what those companies say they're doing is actually being done?
So you typically have someone who looks at the project and assesses it, and then someone independently audits it. So you can have a company like Synergy who designs the project, and then Gold Standard is the gold standard in the industry, comes in and audits it. And so is there a precedent for this, Romaine, right? We're talking about the carbon sequestration property of natural resources. And the answer is yes. There's one country in the world that has done it, and it is Gabon. And the buyer of that carbon sequestration carbon credit was Norway. And they raised $150 million. So this is, again, where I'm talking about climate capitalism, where your carbon can be an asset and it can also be a currency. And I'd like to get into that. So because you get paid as a country on your net carbon footprint, so you want to get your net score down. Well, how do you do that? In a country like the Bahamas, where 100% of the energy is generated by fossil fuels, the obvious answer would be to install solar. The obvious problem is, how do you pay for it? It's not a rich country. And here is where I think the innovation is going to be amazing in terms of, I'll give you an example. Royal Caribbean was trying to offset their carbon footprint. They committed to buy every megawatt of power a wind farm in Kansas generated. Well, let's follow that yellow brick road. What is a cruise ship doing with a wind farm in landlocked Kansas? It turns out it's not the craziest idea. They basically gave a power purchasing agreement for a 200 megawatt farm, which in return generates 512,000 carbon credits for Royal Caribbean for the next 12 years annually. And if they were to buy that in the open market at $25 a ton, that would cost them $12.8 million. So Southwestern, which is the energy company, got their wind financed, and Royal Caribbean got carbon credits. And so that is a model that is typical in company financing that can be applied to countries to finance their energy transition. And for island nations and everyone, the energy transition represents energy independence. And the reason that is so important, Romaine, is a country like this spends $1 billion in fossil fuels every year, has $10 billion in debt, an 86% debt to GDP ratio, and a B+ credit rating. If we could be energy independent, it would be a role model for every other island nation. We could solve our balance of payments problem, pay down our debt, meet our carbon reduction goals with the UN and the rest of the CARICOM, and start a sovereign wealth fund. This is game changing. It's very, very exciting, and I think it's hope for a brand new green day for island nations.
All right. Well, I think that's a wonderful place to end it. This was a wonderful conversation. Barbara Ann Bernard of Windcrest Capital. Coming up, Bloomberg Senior Executive Editor for Economics, Stephanie Flanders. She'll be here on the Fed's hawkish pivot. That's next on Wall Street Week on Bloomberg. Welcome back to Wall Street Week. The dominant theme this week, of course, centered around Jay Powell and what the Federal Reserve will do to tamp down inflation. We got some clarity on Wednesday about what the Fed will do, but investors, of course, they're obsessing now over how exactly it's going to get done. Joining us right now is Stephanie Flanders, Senior Executive Editor for Bloomberg Economics. Stephanie, a lot of people want to know not just when the Fed will start to tighten policy, but how aggressive it will be in doing so and how prolonged this rate tightening cycle could potentially be.
Yeah, and I think that the fact that we're not really sure about the answer to that question, and certainly that investors are not really sure about the answer to that question, we saw play out in the volatility in the markets this week. I think one way I think about it is, we've had an era of gradual but limited rate rises being the only thing that was ever on the horizon. That was the era of forward guidance. And we know that now, and I think markets, particularly after this week's press conference, know this is a slightly different Fed, a different regime. What we don't know is whether we're losing both the gradual and the limited, or we're just going to be going a little bit faster, but still have a relatively modest tightening cycle. And I think that's what people are playing with. Have we got, even if we saw quite a few rate rises, now the market is coming around to the idea we might have 5 rate rises in the US this year. There's this feeling that, OK, that means they won't have to do so much later on because we're still talking about a relatively modest bit of tightening. But if that limited piece has already also gone, that the Fed's not just going to be gradual, but also going to do a bit more tightening than the market was expecting previously, well, that does potentially mean that all bets are off. What do you make of Powell's comments about the idea that the Fed needs to be nimble? On the surface, that obviously makes sense, but that seemed to also spook the markets to a certain degree. Yeah, I think it's because if you think about where we are, being nimble feels like it can only really go one way. It can only be in a hawkish direction, because in the past we've actually come round to the view that the Fed would tie its hands with forward guidance and allow it not put itself in a position where it's reacting to every bit of data as it comes along. It specifically promised the financial markets and everybody else, we're going to hold rates low even when inflation is reaching the target. We're going to hold it even longer than that because that's what our new strategy implies, that we're going to err on the side of having too much inflation. Trouble is, once you have too much inflation by the Fed's own higher hurdle and you've reached that tipping point where you really need to tighten, well, that new framework doesn't say anything about the pace of tightening. It doesn't say that that's going to be any slower than in the olden days. And in fact, it might mean that you have to move that much faster because you've left it too long. What do you make of some of the criticism out there from folks like Bill Dudley, Larry Summers, of course, a contributor to this program, John Waldron over at Goldman Sachs, a lot of relatively prominent people, I guess a little bit concerned that not only did the Fed not move as fast as they wanted to see, but maybe they're not getting the communication as clearly as they would like to see right now out of the Fed? Yeah, and I think there's a fundamental point here, and I've actually had this conversation with Bill and actually with Larry. It's whether we've changed, have the balance of risk changed from what we've seen in all the years since the global financial crisis. In all those years, you'll remember when we talked about, central banks facing tough decisions, there was always the feeling that you err on the side of being too loose, that the bigger risk was that you would send the economy back into recession, or that the bigger risk was that inflation would be too low. I think what Bill Dudley and the likes of Larry Summers are thinking is that, the Fed still has that frame on what it needs to do, when actually the risks now are on the other side. Actually, the risks to the broader economy, not just to inflation, are greater if we are seen to let inflation get out of control. And that's the danger of being behind the curve as they see it, which I think is also, there's some sympathy among other commentators and even among members of the FOMC with that view. There's also, I guess, a question sort of baked into all this about whether the economy and, for that matter, the markets can sort of stand on their own without this sort of extreme accommodation that we've come to expect out of the Fed and from other central banks around the world. Yeah, and it's interesting. We have got used to running the economy and the markets together. What's good for the economy is good for the markets. And of course, there's been many years where the markets have done a lot better than the economy in the last few years. Certainly in the years after the global financial crisis, it was part of that era of super loose monetary support for the economy that you had super performance from the financial markets, even when the economy was quite flat. I think we are moving to a world, and certainly the Fed probably would like to see us being in a world where actually the economy looks a bit healthier than the financial markets. And I think that was also the sort of what was rippling through financial markets this week, was the feeling that, hang on, the Fed doesn't seem to care about us as much as it did before. And I think the response from the Fed is, well, because the economy is growing really strongly and inflation's really high, we don't have to worry about you.
You and your team do a lot of great work at Bloomberg Economics and sort of tracking economic growth and tracking all the elements that go into that. When you look at some of the most recent data that we've gotten, including the latest GDP numbers from the fourth quarter, the rise in the employment cost index, as well as some of the personal and consumer spending trends here, does that suggest to you a healthy economy?
Well, I think when you look at a lot of the data, including the latest bit of data we had on the employment cost index, which is something that the Fed looks at very closely. When our chief U.S. economist Anna Wong looks at that, and she spent many years at the Fed, she sees a green light to at least 5 interest rate rises, and even the possibility that you will see that 50 basis point rise on the first time out, which had been discounted because we know the Federal Reserve hadn't previously felt that that was warranted. If you just look at wages and salaries, that is growing at a rate which is consistent with inflation still being well above target, well over 3% by the end of this year. And that's on the Fed's own measures. So I think most of this data did confirm what I was saying earlier, which is, you have a strong economy and you have inflation, which is clearly for some time been exceeding all the targets that the Fed has ever set itself for a prolonged period. This does set the tone for quite a lot of nimble rate rises.
Look a little bit more globally for us, because if the Fed does embark on this tightening cycle, as most people expect them to do, you have a European central bank that, at least for right now, appears to be willing to stand pat. You have a Chinese central bank that is now appearing to actually become more accommodative. And you have other central banks around the world, lesser central banks around the world, that don't necessarily all seem to be on the same page as to which direction they want to take monetary policy. Does that matter?
Yeah, and you've mentioned actually the most interesting difference out there at the moment is that difference between the People's Bank of China and the Federal Reserve, which we have not seen in living memory. The PBOC being able to go in a different direction from the Fed because it's kind of freed itself from having to follow every step that the Fed takes. The Chinese economy has been weakening, and the PBOC is weakening policy to support that. It's not doing very much for Chinese financial markets, but the Chinese authorities don't mind so much about that. But it does provide a sort of counter force to what the Fed's doing, and actually an interesting thought for investors who've had so many years of the US outperforming other stock markets. I was quite struck by the European stock market actually holding up pretty well this week, despite all the volatility in the US. There's many, many years where people have said this is the year where Europe finally does better than the US. Well, maybe this will be one of those years, but maybe still not a very high return.
Yeah, it could potentially be. And of course, a lot of that will depend on whether policymakers, get in the way of that progress. Let's circle back then to the overhanging issue, which is inflation, Stephanie, and the idea that there are some elements of these inflationary pressures that may indeed prove to be transitory. And that is also raising questions as to whether we do need some sort of aggressive monetary policy tightening.
Well, I think there's lots of different pieces of that, right? I mean, we do think there's some prolonged supply chain issues, though some companies are able to get around them. We saw the Apple results today, somehow miraculously getting past some of the supply chain issues that have dogged other big multinationals. But if you look more broadly, it's not just the sort of the normal suspects, if you like, pushing up prices. I mentioned before wages and salaries picking up at a fastest rate than they have in many years. You're seeing, services costs, not just in those areas that are just opening up in the economy, but more broadly picking up. So I think it's hard to argue now that this is an inflation which is just coming from key bits of the economy. I think the place where that's most true, in fact, is the Eurozone, where energy has been a big part of the price rises so far, and actually we're going to see more coming down the track. But in most other countries, certainly places like the UK, where the Bank of England's already raised interest rates, this is fairly broad-based. We may not be going into a high inflation era, but this is definitely not something that's just going to be a prolonged blip.
All right, well, a lot to keep our eyes on. Stephanie, really appreciate your contributions today. Stephanie Flanders there, Bloomberg Economics Senior Executive Editor. Coming up, the compensation conversation. That's up next on Wall Street Week on Bloomberg. Finally, one more thought. It's about keeping employees happy. With inflation up the most in 40 years and labor force participation down near the lowest in 50, U.S. workers are finding for the first time in their careers they have an edge in salary negotiations. You see it reflected in Labor Department data that show a surge in the employment cost index, and you see it in data that show record high rates of people quitting their jobs for greener pastures. On Wall Street, Goldman Sachs is said to have added millions of dollars to compensation packages for hundreds of its top executives to prevent defections.
On compensation, our philosophy remains to pay for performance, and we are committed to rewarding top talent in a competitive labor environment.
Bank of America is said to have boosted pay by about 25% for senior bankers and is offering other employees a share in a $1 billion pool of restricted stock. CEO Brian Moynihan, he spoke to us last week.
We've increased the compensation of the company dramatically across the years. But how do you make that all work? Well, you keep engineering the company, keep working on processes to take out cost and reinvest it in the people.
Citigroup is raising base salaries for first-year analysts, and J.P. Morgan has boosted pay for junior bankers twice in the past 7 months. J.P. Morgan CEO Jamie Dimon, he says it's worth the cost to keep top talent.
We will be competitive in pay. If that squeezes margins a little bit for shareholders, so be it.
But it's not just people in finance getting showered with this extra money. Bloomberg reported last month that Apple was giving its computer engineers unexpected bonuses into the six figures to keep them from jumping ship to competitors like Facebook.
This is not something that I believe Apple has done before. And this is really an effort to retain key talent. Apple is, losing talent right now. There are more than usual number of people leaving.
And in the retail world, Target is offering to pay the full college tuition for its U.S.-based employees. Even further down the scale, a record 48% of small business owners said they raised compensation last month, and almost a third said they plan to do so in the months ahead. All of this constitutes a significant, if not long overdue, power shift for U.S. workers. But shifts like these inevitably raise the question of tipping points. When does what's good for the worker become what's bad for the economy? It's a question that has to be posed, and posed delicately, to be sure. But it's one that is clearly on the radar of the Fed. Chair Jerome Powell has cited last year's surge in the employment cost index as a key reason for pivoting to a more aggressive stance on monetary policy. In addition to the pandemic effects, he's acknowledged structural demographic shifts that will likely constrain labor supply for years to come. And Powell knows that globalization is not going to be the savior in weighing down prices the way it did last century, which means now the Fed and investors need to prepare themselves for a new and, dare I say, less transitory economic dynamic. That does it for this episode of Wall Street Week. I'm Romaine Bostick, in for David Weston. This is Bloomberg.